Later today, we're going to have a panel of community bankers to talk about capital and liquidity regulations. So I wondered if you might be willing to share your views and thoughts about how we could appropriately calibrate those capital and liquidity levels, especially for community banks, but maybe more broadly across the banking system to be more effective for economic growth and how to support the economy going forward.
I think if we take a step back, we could see that the substantial amount of credit that is being grown outside of the regulated banking system tells you that the regulatory framework that was developed post-Dodd-Frank is too tight, and that there is this substantial arbitrage to be done, whether it's vis-a-vis big banks, whether it's small banks. Why do we have private credit that is bundling loans and then receiving lines of credit from banks? Let's get back to the primary lending function. Let's make capital more risk-based. Let's understand that there's a lot of work to do in terms of bringing this back down to common sense levels. In terms of knowing your client, in terms of releasing what I would say is this regulatory straitjacket. And famous last words, I think private credit is a dynamic new aspect that increases the depth and breadth of the U.S. financial system, but it can't be to the detriment of the regulated system, because my real worry with private credit is everyone in this room, all the bankers, and look, I met a lot of banks who've been going since the 1800s. And if you've been going since the 1800s, you know a lot about risk management. You know how capital works. You know how your clients are. My worry with private credit is it could be very pro-cyclical, that without stable deposits, in terms of if there were a downturn, the way Treasury and Federal Reserve would work together would be with window guidance, would be with regulatory lessening the regulatory parameters, and to restart the economy in a counter-cyclical basis. So we also want to look at that. And again, too, a lot of the things we want to do, we want to make it easier to operate. We had a small community bank from South Carolina a couple of weeks ago in one of our panels. I think it was 185 million of assets, 17 employees. I think 5 were for compliance. So, and no one is more focused right now on financial crimes. Our FinCEN department is 24/7 in terms of what we are trying to work on, but we're also trying to add a common sense layer. Can we do geographic targeting? If we see that a huge amount of the narco finance is along the border, should we lower SARs there and raise them everywhere else to avoid all this regulatory expense?